Good afternoon, everyone. My name is Professor Arun Upadhyay. I'm a professor of finance in the College of Business. And I work on climate finance. I'm also one of the environment finance fellows of the Institute of Environment. After the great speech by Professor Williams, now we can start looking at this discussion on the real impacts of climate change and hurricane losses, and the industry that is helping citizens to deal with the catastrophe. We have a great panel here. We have Mr. Jackson, who is the Deputy Assistant Administrator of FEMA for the Federal Insurance Director. He leads flood insurance operations for National Flood Insurance Program. The program serves almost 5 million policyholders, collecting almost $3.5 billion in premiums. He has done an amazing job to manage the flood insurance program by launching this risk rating 2, which has helped with the collection of or calculation of premiums rather. In a better manner. And then on his right, we have Mr. Yaworsky, our Florida Insurance Commissioner. He has served, before taking over as the commissioner, he served as vice chairman of the Florida Gaming Control Commission, and before that, he was the chief of staff of the Florida Office of Insurance Regulations, where he assisted in overseeing one of the largest insurance markets. Then on the right of Mr. Yaworsky is Mr. Mishra, Rakesh Mishra. He is the CEO and president of Casualty, and he deals with the policyholders who are affected by the hurricanes and these extreme events. Before taking over as the CEO of this company, he worked as VP of Zurich Insurance Company, where he built predictive models for catastrophic events. He also worked as a VP of product for Hartford Insurance and as product manager of Progressive Insurance. And then we have Professor Winkle, who is Associate Professor of Public Policy and the coordinator of Coastal and Ocean Policy Program at UNC Wilmington. Her work has gotten a lot of interest. She has given testimony to U.S. Senate on these issues. And then we have Professor Shahid Hamid. He is a professor of finance. He was the department chair and just stepped down as chair. He is also the director of Lab for Insurance, Financial and Economic Research, and he works on with the International Hurricane Center, modeling catastrophic losses. So we have a fantastic panel here. Now I invite Mr. Jackson to give his presentation. Thank you.
Thank you. All right, step one is knowing how to work the technology, and we're there. Good afternoon. It's great to be here and to speak to you all. Appreciate the opportunity. Mario is around here somewhere, but thank him for his hospitality since we've arrived. And we're thrilled to participate and talk about what is really an important moment for the National Flood Insurance Program. I'm delighted to share our perspective with you, some information about the work that we're doing, as well as some information about the challenges that we have. One is that our reauthorization is set to expire unless Congress acts here soon by March 8th. In the meantime, we're continuing to work every day to build an enduring NFIP that is going to be around for generations to come, but is also going to meet the challenge of today's landscape. And given the uncertain and unpredictable climate future that we have ahead of us, it's more critical than ever that we have a strong national flood insurance program. The question is, what can we all do as citizens, as climate scientists, public policy makers, researchers, and insurance professionals like we have in the NFIP and across our partner network to close the flood insurance gap and reduce the needless human suffering caused by flooding events, both large and small. Large events like Hurricane Ian and significant rainfall events like we've seen in the past year from South Florida to San Diego continue to point to a changing climate. As we face that changing climate, we must unite around a common purpose, as we often have in our nation's history, Americans coming together to solve the pressing issues of our day. What we know is that nature is not waiting around on us, and that's what we've been here to talk about today. NOAA now lists Hurricane Ian as the third costliest storm in the United States, more than $113 billion in damage. The NFIP will pay out $5 billion here mostly in Florida for Hurricane Ian. And that's not even considering the non-damage cost, disruption of daily life, disruption to commerce. What we also believe at FEMA is that the status quo just isn't cutting it anymore. It's what our FEMA administrator recently referred to as a turning point. One in which the actions that we take now will have a tremendous impact on future generations. We have to build stronger and more flood-resilient communities capable of weathering this new normal. And of course, I speak the most about flood because that's our business at the NFIP. We should all remember that flood continues to be the nation's #1 natural disaster. It's the natural disaster most likely to happen to any of us. And yet, despite the growing threat of flooding, it remains underappreciated. We are seeing it in the NFIP's policy count, which has continued to go down over a number of years in a pretty steady fashion. The good news is our numbers have begun to level off with fewer decreases than previously since our move toward more risk-based pricing in 2021. From August of 2022 to 2023, our policy count was down about 1% compared to 3% per year in the years before that. But we're not seeing the increases in policy counts that we need to strive for. So we have to figure out a way to bend the curve back upwards and encouraging more people to purchase flood insurance. The outcome that we seek is more insured survivors. So whether that's insuring with the NFIP or whether it's buying a private flood insurance policy, which is increasingly available to many citizens, ultimately less disaster suffering comes when you have a flood insurance policy. What we are seeing and what we've talked about here in the last 2 days is $1 billion disaster after another. In some areas, we're seeing fewer insurers to weather them. Here in Florida, 11 companies have gone into receivership over the past 8 years, and when it comes to those who are still in business, some have decided to stop offering new policies, while others have limited the policies that they're willing to renew. That's a trend we're beginning to see all across the country. It's not just Florida. We see it in Louisiana. We see it in California. Of course, the thing you have going for you here in Florida is that people are rapidly moving here to the tune of nearly 500,000 residents in 2022. I think it makes you the fastest growing state. Florida has a lot going for it, but as we look how to battle the climate crisis on a national level, Florida will become more and more relevant. And the things that we do here to protect ourselves and to ensure ourselves from the peril of flood will be that much more impactful because of all the population growth that has happened recently in Florida. When we look at the penetration rates across what represents FEMA's Region 4, they're at 15.1%. Florida is leading the way, but it's not nearly enough. Nationwide, it's around 4%, according to the Insurance Information Institute, even though 90% of U.S. disasters involve flooding. What we also know is that the flood protection gap is felt most by the communities that have historically been overlooked, where circumstances have put flood insurance out of their financial reach. What I'll also say is that even as NFIP policy counts are declining, we're seeing growth in private flood. The private flood insurance market now accounts for a bigger piece of a growing pie. In 2016, 12.6% of flood coverage was written by 18 private companies. You move ahead to 2022, 32.1% of flood coverage was written by 77 private companies. The Insurance Information Institute goes on to say it's reasonable to expect that trend to continue. And a lot of that is down to improvements in data. I was delighted to follow a conversation about modeling. It is the way the entire insurance industry is moving, and it's a critical underpinning of Risk Rating 2.0, our new rating methodology, which I'll talk about here in a moment. At FEMA, we're committed to increasing the number of insured survivors, as I said before, and we've really put our money where our mouth is. By moving to risk-based pricing and Risk Rating 2.0, we've allowed private insurers to truly compete with the NFIP and to offer a sound solution and alternative to the flood protection gap. I'll go back a little bit to the NFIP slice of the pie here and talk a little bit more, just with the rest of our time, about what we're doing here to meet the moment and close the flood insurance gap. What we're doing is really looking across all of the work that we do at FEMA, everything from examining the future of flood risk data. That's going to be FEMA's answer to some of the work that the First Street Foundation and others have done in relaying flood risk. We're going to be looking at high-risk properties, revisiting the NFIP minimum standards. We'll come to Risk Rating 2.0 in just a moment. But we really are trying to lay the groundwork for long-term sustainability as best we can. A framework that allows us to enact change when it comes to how we as a country deal with flood risk, but also to hold ourselves accountable at FEMA for outcomes relative to the federal investments that we make. I mentioned the reauthorization of the NFIP. If we're going to continue to make progress addressing flood risk in this country, we have to stop threatening to let the NFIP lapse. We're on 28 short-term extensions, 3 brief lapses of the program. It's not only disruptive, it causes existing and potential policyholders to lose confidence in the NFIP. It holds up real estate transactions, and it costs in countless inefficiencies in having to stop and start thinking that the program might close down, even for a brief period of time. We continue to support a longer reauthorization, and to do that, we've proposed 17 legislative reforms, which you can review on FEMA.gov. I'll talk through some highlights here as we move along. The first is that affordability, it'll come as no surprise, is the most significant barrier to accessing flood insurance, and one of FEMA's recommendations addresses this factor. We know from research that too many families are trying to prioritize between putting food on the table and purchasing things like flood insurance, and that's really no decision at all. Necessities are going to win out every time. It's why we continue to be a voice for affordability, as we have since 2018. It's why we proposed a means-tested affordability program for Congress's consideration that's been in the administration's last 3 fiscal year proposed budgets. Lawmakers often ask us, what do you say to families who can't afford flood insurance because you're moving to risk-based pricing? And I try to be very clear with them, as I will be with you. By law, we cannot. We are tasked with providing actuarially sound rates, using the best science available to us, and that's really what Risk Rating 2.0 is an attempt to do that and follow congressional intent. So the ball is in Congress's court. We need legislative action and dedicated funding to truly tackle affordability. And if we don't, it's going to continue to be an issue. The NFIP also has to have a sound financial framework, which in the wake of increasing flooding and our existing debt is a key to getting our financial house in order. As many of you know, when what we have to pay out exceeds what we have brought in, we borrow. Congress has repeatedly raised the NFIP's borrowing authority rather than address the structural flaw of the program. So we believe canceling the NFIP's debt and starting anew is critical to a sound financial framework. Only Congress can do that. The NFIP is saddled with $20.5 billion in debt, largely from previous catastrophic storms dating all the way back to Hurricane Katrina in 2005 as we sit here in 2024. At current interest rates, we pay more than $619 million a year in interest costs to the Treasury. and have paid over $6 billion to the Treasury since we incurred the debt. That's $6 billion that's not there to pay claims. It's not there to buy reinsurance to protect the NFIP. We can't use it for mitigation grants to help communities become more resilient. It's just gone. And that's the debt picture with us paying an average interest rate of about 3% due to some prior financing we had back when interest rates were better. We have a note maturing next month, which will push our interest costs even higher as we borrow at today's rate. So the NFIP's debt is only going to continue to grow. In the meantime, we're doing everything we can under our current authority to deliver affordability, but also improve the fiscal solvency of the program. And many of you can see and think about the inherent tension that exists within the program, a desire to have flood insurance be affordable, and then on the other hand, a desire for it to be self-sustaining financially. So we'll talk about a little bit about Risk Rating 2.0. It's built on the catastrophic modeling. The best available catastrophic modeling, as Professor Emanuel pointed out. There's only a few games in town, but it is the federal government. We have the ability to use some internal data, which both FEMA data and internal to government data to round things out. But it really is moving. The thing to know about Risk Rating 2.0 is it's moving from a deeply flawed system from the 1970s that had a number of inequities in it and had people not paying for their fair share of the risk, and moved to the best available of what we have now. It's not perfect. Nothing is perfect in the catastrophic modeling world and also in the actuarial science world. Everything is a projection, and only time will tell how good our projections of average annualized losses are, which is the key to setting up any insurance program. But with Risk Rating 2.0, everybody pays for our best estimate of their own flood risk and not somebody else's. We take into account a number of factors that weren't previously taken into account, the most important of which is rainfall. The rates prior to Risk Rating 2.0 charge nothing for rainfall because they're not included in the flood maps. And so thinking back to our prior projection, the light blue, the fresh water, that was about fatalities, but there's also a consequence to that in terms of property damage. None of that was accounted for in the pricing methodology. So it shouldn't come as a surprise to any of us that the NFIP didn't collect enough money to pay out all the claims that it had. So with the implementation of our new pricing approach, we have set targets for average annualized losses, and FEMA is able to equitably distribute those premiums across all policyholders based on the home value and a property's flood risk, and set rates that are fairer and more equitable. Notice I didn't say they're perfect. They're fairer and they're more equitable than they were. A significant aspect that, for whatever reason, doesn't get a lot of attention is Risk Rating 2.0 dropped premiums for nearly 1 million policyholders because we found that they were paying more than their fair share of the risk. That was about 23% of policyholders. They received an immediate decrease of $577 million, which averaged them about $627 for everybody who received a decrease. The alternative, had we stayed with the old methodology, would have been that those folks who were overpaying would have continued to see increases year after year after year. And despite all the press and the conversation, most of the people under Risk Rating 2.0 experienced increases that were about the same as under the old methodology. What Risk Rating 2.0 was about taking the riskiest properties and making sure that they pay their fair share, and taking the least risky properties and making sure they're not subsidizing the riskiest properties. That's it in a nutshell. One of the good things about our program is we have a glide path. So by law, premium increases are capped by Congress at 18%. For repetitive loss properties, it's 25% by statute. Meaning that some of the policyholders that were the most mispriced will move to risk-based pricing over 5 or even 10 years, and we have some that will take longer than 10 years to reach risk-based pricing. And then, of course, new business entering the program is no longer discounted or subsidized. They come in at full risk rate. So risk rating 2.0 is putting us on the right course to financial stability, along with our other proposed reforms. By 2026, importantly for our financial solvency, about half of our policyholders will be at full risk. And so we're certainly moving in the right direction of ensuring that we do the most important thing, which is to collect sufficient premium to pay out the claims when there are big losses like Hurricane Ian. We're working on some other exciting things, installment plans. Many of you may not know that our program, because of the way it's legally been set up, we have to take all the money at the beginning unless you're in an escrow situation. And so we're going to get that corrected. And we have a new flood homeowner form, which is moving through the rulemaking process that will make our flood homeowner form look and feel more like homeowners insurance, which we think is critical to helping make it easier for agents to sell and customers to buy our product. So as we close out, I have a few things that I hope you'll take away with you. One, the most important thing you can know, it was alluded to earlier, flooding is not covered by your homeowner's insurance. If you take away nothing else from my time with you all day, please make sure you're crystal clear on that. Tell a friend and a neighbor. We meet people after every disaster who are absolutely convinced that water from outside their house is covered by their homeowner's insurance, and it's not. The second thing is just to get involved. We are tremendously grateful to FIU, not just for having us here for this event, but also the flood loss model building efforts with Dr. Hamid and the College of Business, the building codes work on the Wall of Wind. Certainly, we're always delighted to be down in South Florida and talk to our FIU partners. It helps me personally in that my in-laws are here in South Florida, so it's always a good excuse to score some brownie points and get down here and talk to all of you. And then finally, what I would ask is that you really continue to help us bring momentum to the movement to reduce disaster suffering. And so many of the conversations, even when we disagree, that have occurred here these last 2 days are critical toward maintaining the momentum of that movement. We need the whole community to share in this responsibility. One other thing I'll leave with you is insurance is only one piece of the puzzle. We cannot insure our way around climate change risk. We can't build better insurance policies that are going to save us. We have to continue to mitigate against the future risk of flood loss. Someone used the example last night, and so I'll use it again. So much like planting a tree, the best time to mitigate flood loss was 20 years ago, and the second best time is right now, today. So I think we have to continue to keep that in mind. Congress has provided FEMA with historic levels of grant funding in the mitigation space. Many of them will be coming right back here through our post-disaster programs to the state of Florida. And so I encourage all communities to look at the things that they can do to mitigate their flood risk. And at FEMA, I would just leave you that we're committed. We're here together. We want to see the state of Florida use all of the FEMA grants to the maximum extent they can, because as I said, people are moving like gangbusters to the state of Florida. So as this climate changes, Florida is going to become more and more of a picture of what we do nationally. So with that, I look forward to joining my panelists and answering some questions.
Thank you, Mr. Jackson. So we are going to invite Mr. Yaworsky and give us some ideas about what is going on with the insurance market or insurance industry in the state of Florida. So, Mr. C.
Sometimes you have to swallow these things before you get what you need. My first thought after hearing this presentation and hearing the tail end of the last one is that I'm so accustomed to dumbing down the issues of Florida's property insurance market to make it consumable to your typical person, but this time I'm a little concerned that I won't be able to smarten it up enough. It's clearly a very, very intelligent audience, and my co-panelists here are fantastic. What can we say about Florida's, particularly its property insurance market over the past decade or so? It's been a very difficult ride. The office's position is that, principally speaking, the direct causes of the crisis that we find ourselves slowly creeping out of was a tremendous upswell in litigation, a huge development of adverse loss reserve development resulting from litigation, and reinsurance costs on top of that rising, and the natural catastrophes that Florida faced, which perhaps were not well enough baked in to an evaluation of what the true risk of writing in Florida was. It had been over a decade between the time of Hurricane Irma and prior storms and the crisscross events that took place. And so Florida found itself a bit perhaps caught off guard for what the true risk of a storm was. Today we have $10 trillion of at least of built up property within the state of Florida. It's a beautiful paradise, but it is a very, very, very costly place to insure, as we're learning. Some good news that we're beginning to see across the market generally, as we look at some of the tort reform that has taken place in the prior years. As everyone probably knows, the legislature passed Senate Bills 2A and 2D during two special sessions in 2022, and then an additional tort reform package and an insurer accountability bill in 2023. They also provided the Office of Insurance Regulation, my office, with several $1 million more in resources and 29 new positions targeting specifically solvency and market conduct activity of insurers. I think when we're just talking about insurance real quick, I think where we're headed right now is we're seeing good news on almost every front. Reinsurers are generally easing off their pay and pressure points in Florida. They are more focused at the moment on emerging crises in California, but especially the Midwest, as that has had a very difficult time, perhaps related to what we've all been talking about here with severe convective storm events that are cropping up like mad in that area. The other thing that has been really helpful, I think, to a more positive outlook to Florida is there is capital from a perspective returning to Florida. There was almost no interest in either infusing capital in a Florida domestic insurer 2 years ago. This year we find significant interest. About the second half of last year, we saw significant interest come in. We saw several fairly well-capitalized entities, including one that ultimately has access to over $1.2 billion, form a company within the state of Florida, which during the peak of the crisis, which was probably 2022, we would not have even dreamt of having taken place. So there's a more optimistic outlook generally in the markets. There's a belief that a number of the reforms that have gone into effect will allow us to rebuild this market in a more sustainable way over time. The challenges that there are challenges that are fundamental to Florida's marketplace will never be Nebraska. I think as probably you've heard all throughout this discussion, but there is a pathway to a sustainable measure. It relates to some things that we've talked about extensively at the office, which is really data collection and analysis and understanding. One of the things that I've experienced recently is Florida has done amazing things over the past 30 years post-Andrew. Whether you point to the creation of the public model, or you point to the creation of the modeling commission, which most states use to evaluate the efficacy and the reliability of models throughout the country, or you look to the creation of Florida Citizens or the creation of the CAT Fund. All these things have been just very good responses to the challenges we've had post-Andrew. But we do need to be moving in the direction of utilizing the talent we have in the state, whether that be the terrific folks at FIU through the model or other entities within the state, to develop a long-term outlook on what Florida's insurance market won't look like just in the following year, but really the following 5 years, the following 10 years, the following 20 years, to at least begin to long-term evaluate what the challenges are. With that, I'll stop.
Thank you. So, I would like to invite Mr. Mishra and see what he has to say from the industry's perspective, how they are managing the challenges of insurance, programs in Florida.
Start a slide deck. But while we wait for the slide deck, so I'm here representing, in a small way, the insurance and the reinsurance industry. And one of our colleagues at the companies we work with is Howden Tiger. They're one of the largest brokers in the world, in the top 5. And so they've really prepared all the data and the slides that you're going to see here shortly. How many of you have had your home insurance prices go up? Sorry, Commissioner, I have to start with, with the accepted belief. Yes. And by how much? 20, 30%? By significant amounts, right?
200%. Over what period? 20% in the last year.
Just 20% just in the last year. So insurance is an area that we feel the effect of what we've been talking about mostly over the past 2 days, which is climate change, extreme events, things of that nature. And insurance companies price for that, but as we talked about earlier, it is difficult to build the best predictive models in order to price that very precisely. We use historical data, but still that is not proven to be enough to be able to price that accurately. We're catching up, and that's why we're seeing increases in prices over the past couple of years, where now we're starting to get to a point where now, or maybe in a couple of years, where the price level is where it needs to be, allowing companies in the insurance industry and the reinsurance industry to be able to break even and make some profit as well. You have it?
Next.
All right. So what is the state of the CAT market, the catastrophic climate market? So if you look at that, on the left side, the demand drivers, there's significant demand for insurance. The supply, there are some constraints around the supply, and hence there is a gap, there is a problem. It is a hard market, as we all know. Hard market means the prices go up significantly. And some of the drivers of the demand you see is insurance to value. More people are becoming aware that they need to insure it to a certain value, their existing properties. There's an increase in amount of insurance that people are purchasing to the value of the property. The property values have been going up as well. Of course, inflation cost, climate is certainly a big component of it, and being able to predict the impact of climate also is a key component of drivers of demand. On the supply side, after we had the Hurricane Ian loss, there's been a bit of a supply issue from a reinsurance and perspective as well. And of course, you see from a supply side, the losses have increased. The market to mark-to-market value in terms of investment, we have seen some losses in the reinsurance industry from that perspective, leaving a bit of a gap between demand and supply. And that's why you see on the right-hand side the risk-adjusted property CAT rate online, which is rate online is sort of like a price per unit of risk. So if you normalize for risk, what is the price per unit? And it is indexed to 1992 at 100, and you can see that go up significantly in the recent few years. We have faced some headwinds, and this is mostly, as you can see, 2022 data, and where we have the insurance companies have had to retain a record amount of risk. It's about $39.4 billion retained by the insurance carriers, because the insurance carriers were not able to find reinsurance in the marketplace. It was tougher to find. The prices were higher, so putting more emphasis on the insurance companies, which becomes a tough position for the insurance companies to be in, generally speaking. And you can see that 41 separate events, CAT events, happened in the first half of 2023, which itself is a record. You can see on the right-hand side up there, it is the highest of first half of any year over the past 20 years or so. So on an average, a significant property claims event happened 1 every 4.45 days. That is huge. And in the bottom, you can see, again, you look at all states, all perils, and you can see the frequency and severity of those have been going up in the recent few years, especially since 2019 into 2022. So where do we sit today? So you can see the history from 92 all the way. I can see the curve has gone up recently, again from 2018 or so onwards. And if you look at the average here, in the past 6 years, the average model loss, the trended estimates by peril, and you can see named storms there being one of the highest in terms of increases, but the past 6-year average per year is 90 billion. If you look at the average over 20 years, it's what, 4 billion, right? Oh, so 54 billion. 63 billion and 90 billion. So that is a significant increase. You can see that in the more recent few years, it has gone up. If you look at the average between a 20-year average versus a 6-year average, it's an increase of about 65%. So these are actual sort of dollars that impact the insurance and reinsurance industry. And when you look at it from a cost of capital and from investment for a reinsurer perspective, it's been hard going. Although as you look at 2023, and I think for the first time in the recent cycle, in the past few years, we're starting to see the ability for reinsurers, as the commissioner just pointed out, starting to come back into the market and provide more capital this year and towards the second half of last year. But it has been a tough going, as you can see. Insurers and reinsurers have lost money over that cycle. Yeah.
I'm sorry, and I'm sorry if you already covered this. I'm sorry if it says it on the slide, I just can't read it. But this is nationally or in Florida?
Yes, this is that's right. This is nationally, that's right. Countrywide. This is not Florida specific. And as you can see, with Ian, the capacity came down in 22, but the dedicated reinsurance capacity. But now in 23, it's been starting to come back up. And so that's a positive news. But you can see that there was a drop in capacity in 22. It was a very hard year that affected many companies across, and certainly in probably disproportionately it affected Florida as well. I just want on this piece just focus on the thing on the right-hand side, which is average annual loss. And this is kind of a very risk source of data. And you can see over those 10, 11-year period, the average annual loss going from about, 59 or so to 133, in 23, and projected to continue going up into 24 as well. That is a huge increase. Now, when you come to Florida, thanks to the commissioner in the past year, as you said, we've had a really positive news in Florida because of the passage of 2 key tort reform bills in 22. This is not necessarily directly weather related, but weather causes the loss. And when the loss is caused, it could be wind related, could be water related, leaking roof, things like that. The cause of loss could be weather, but it affects the property. That's where you come into a potential litigation scenario of claims. And tort reforms have started to show, we've started to see that in the data where 2 key reforms that were passed in 22, there was another one in 2023, as you had mentioned, are starting to produce results from a lower frequency of representation of suits, lower demand convert to suits. There's a demand needs to be made by an attorney with the insurance company. So we're seeing improvement, lowering of demands, lowering of suits, but also the severity part of that is starting to come down as well. So I would say as an industry professional, for the first time in the foreseeable past, I guess, 20 years, the reforms that were passed in Florida the past couple of years have been the most impactful. And not to say that, you know, as insurance companies, we are also held accountable, rightly so, the accountability law in terms of, hey, we need to make sure we take care of claims fast, we take care of claims fairly, and provide a good customer experience to our insurers as well. So it has been a significant improvement on the regulatory front, but there are many other areas that affect insurance. Construction, the whole construction industry, the cost, supply chain, inflation. Insurance is something that affects everybody, whether it's it affects you personally, your car, your home, or affects your business as a property, business as a liability, business interruption. It affects us all. And as somebody who is in this profession, I would like to make a sort of a plea for more folks to get involved in understanding, doing more research within insurance, understanding it better, trying to come up with programs, being creative, trying to come up with programs that could mitigate part of the risk we are facing. Insurance is not the answer, but it is one of the factors that needs to be considered more and more than it is today in order to mitigate risk, understand risk. Insurance is risk management, and risk is what we all face every day. All right? Thank you.
Thank you, Mr. Mishra. And now I would like to invite Dr. Winkle to say something about this.
So thank you for having me here, and I'm really grateful to be able to participate with this panel. Yep. Better? Okay. So I pulled together a couple of comments, and really they're more about the dynamics that I've been watching play out over the years between the industry, and when I say that, I mean insurance, reinsurance, and the ILS market that reinsurance interacts with. So I'm going to just start off with a couple of headlines that recently came about. So I was watching some videos from Artemis throws a convention, I guess, every year in New York City for the ILS market. And they had a particular panel on Florida and specifically Citizens Property Insurance Corporation. And one of the things that came out of that panel discussion was a point that fundamentally reinsurance drives the Florida catastrophe market. And I thought this was an interesting note because of that you had this other entity, and we talk about it, but there's this other entity playing a very active role in Florida that maybe it doesn't play to the same extent elsewhere. So that's one thing. The other news headlines more recently, I think within the last week, was that perceptions of climate change may present an opportunity rather than a threat to the ILS market. And then John Seo of Fermat has kind of echoed this sentiment a couple years ago when he said the greatest source of alpha in our market is the media dynamic regarding climate change and disasters. So there's yesterday I had mentioned it, that the media is playing a role in perceptions of risk, influencing investor demands. Next week, the Trade Association, the Reinsurance Association of America, will have their annual conference. And there's two talks that caught my attention. One is by the NOAA administrator, and his title, and granted these talks have not taken place yet, and I'm not going, but anyways, it drew my attention. His talk is about who develops hazard data and what is the government's role. And that's coming out of NOAA. And then another talk was about catastrophe modeling and attempts to emulate the latest scientific consensus around the range of possible outcomes. What we had talked about at lunch was that consensus can have some rather serious politics involved in it. There's a robust literature on the serious issues in climate science and its politics. Why does some information end up featured in assessment reports and not others? Problems in the IPCC process, and pressures environmental scientists face to fall in line with certain messaging around climate change, and the observation that diverging viewpoints are not well represented in assessment reports. So the context matters for thinking about the influence of the reinsurance industry in climate change science. That's been going on, I want to say, since the 90s. I think climate science has always been of interest to the insurance industry, but the reinsurance industry got heavily involved with that, I believe in the 90s, trying to grow out the catastrophe bond market. So, and this has weighed heavily on the risk assessment process. There is, you can see then a positive reinforcement where industry is driving certain areas of literature and then picking up that literature and legitimizing it through its use in modeling. So you have the Risk Prediction Initiative, Willis Re Research Network, which was a global sort of thing amongst climate scientists, where reinsurance was pushing money out for research there. There was an initiative on extreme events at Columbia University. There's been a lot of industry money in the Watson School and Risk Management Center. And all of these are they're locations of very dominant and influential views on science and the insurance industry and public interaction with the industry. Most recently, perhaps, is currently a funding initiative by the National Science Foundation to NOAA to provide climate modeling for reinsurers. So that's public money for climate modeling for the reinsurance industry. And this should be considered also in the context of ongoing pressures, I think, and some oddities maybe at NOAA in reporting about hazard data and our experience with disasters. You have some drama, if you will, and curious reporting in their billion-dollar disaster set, or at least a willful willfully allowing for a misinterpretation of what that data set reveals. There is sort of a coordinated campaign against Atlas 14, which is a measure of precipitation. I don't doubt that that might need some advancement or improvements, but nonetheless, there's been a lot of pressure on NOAA about that. And then there's been some reports that hurricane forecasters, those that are actually saying, okay, the hurricane's going this way or that way, and we're all watching the news to do this, are making concentrated efforts not to pay attention to certain aspects of what's going, or certain ways that investments are structured, the way bonds are structured, so would not allow themselves to be swayed on how to forecast a certain situation. There's been some reporting about that. So NOAA is under a lot of pressure. And this matters because traditionally, there has been a concern about public access to its own information about itself. The insurance industry, I think Kerry had mentioned it in his talk, where it's not only always easy to access that private loss data. Rightfully or wrongfully, that's the way it is. And so the public data, as NOAA has reported it, has been very important for critique and on technical processes regarding insurance. So there is a dominant narrative, I believe, around the public problems with insurance, and it mainly focuses on methods of risk assessment. And this favors an incredibly highly technical form of politics that the public and I dare say some regulators have difficulty engaging with. Because not only is it the technical processes and highly complex situation within its own right for the industry and the way that they do things. But now you're layering on top of that all of the conflicts and the social dynamics around climate science. So you're laying that all together and then asking the public to interact with that and say something. It creates a lot of barriers to entry as far as having a public opinion goes. It also controls the options around pricing. And so basically, as we are facing a issue with the cost of our disasters, managing our insurance regimes to serve the public and the economic activity that we would like to do, the focus has become on insurance pricing and risk assessment rather than alternative financial options. Or is that money better spent on increasing insurance prices, or is that better spent on, I don't know, a seawall or whatever, some mitigation stuff? Where are we going to put money? Anyways, as a final note, I'll say that science and insurance and maybe broader finance lean on each other for legitimacy right now. They've both become very entwined. And it's not fully transparent. The former, in particular, the entire climate scientists have not been fully transparent about the extent to which they've been interacting with the industry and the influence that the industry has been playing, perhaps, on manufacturing consensus around certain views of climate and the future. Thanks.
Thank you, Professor Winkel. I would like to invite Professor Hamid.
Hi. So I'm going to jump around a little bit because Arun gave us a list of things to talk about. So this one? Yeah. Okay. This is the insured residential commercial property value by states. And you can see Florida has 79% coastal exposure. Property insurance premiums have increased nationally by 32%. That's the Insurance Information Institute between 2019-23. Florida, it has doubled, tripled. I, for example, used to pay $3,000 premium 12 years ago. I'm 20 miles inland on a $450,000 exposure, and now I'm paying $13,000. Flood insurance has gone up from $550 to $700. Really cheap, but of course the coverage is only $250. Point I'm trying to make is that we have had quite dramatic increases in pricing, and the question is why? Well, of course we have increased risk wind hazard. We have increased exposure of coastal areas, but the important point is that the cost of rebuilding has gone up. Okay, nationally, premiums went up 32%. But because of increase in the cost of material and so on, between 19 and 23, cost of rebuilding has gone up 55%. And with replacement cost policy, it's not the value of the property, it could be land value that's going up. It's really the cost of rebuilding that matters. And that has outpaced, at least nationally, premium. I'm not sure what the cost of rebuilding, how much it's gone up in Florida, but that's one of the issues. Increased cost of reinsurance. Worldwide, we have had losses, insured losses of more than $100 billion in 6 of the last 7 years, and that's obviously going to affect the reinsurance pricing. And then in Florida, we have also cost of lawsuits. We have the assignment of benefit problems and a lot of litigation. We have the wind versus flood problem. The assignment of benefit basically involves a lot of fraud, especially in South Florida. So contractor will knock on your door and say, okay, we had some hurricane recently, or maybe 2 years ago. I'm sure your roof has been damaged. We'll get you a new roof. Okay? Just do an assignment of benefit. will take care of all the claims, will fix everything. You don't have to do anything, and they'll go ahead and send a bill, whatever bill they want to the insurance companies. So we have 9% of the claims originating in Florida, 79% of the lawsuits originating in Florida. The insurance industry paid $3 billion in legal fees in 2019. So that's really an issue. And the other issue is you have, as I mentioned earlier, that you have 18% insured, actually now it's more like 15% flood, and we have something like 88% insured, regular homeowner insurance. And so vast majority of them don't have flood insurance. So when there's water damage, they file lawsuits saying that it's really the rain leaking through the roof or through the openings that's caused it, and so insurance companies should pay for it. And in some sense, the Supreme Court of Florida in 2016, I think, changed the game a little bit through this concurrent philosophy and so on. That means if you're not 100% sure what caused the damage, okay, and even if the damage was caused maybe 10% by wind or related water leak, but as long as there's uncertainty, the insurance companies may have to pay 100%, as long as there's uncertainty. So that obviously increased the cost, and then the insurance companies started putting in amendments in the policies for anti-concurrent. And the point is the process is ongoing. There's a lot of legal lawsuits, thousands and thousands of lawsuits going on. And which bring back to the issue is why is the flood insurance coverage so low? I mean, obviously we don't require flood insurance. The mortgage companies don't in the low-risk area, but it's cheap. I'm paying $700 compared to $13,000, so there should be obviously a lot more flood insurance people insuring, but that hasn't happened, and that's an open question for our director here. We have only 4% nationally that's covered, right? And so obviously I understand that there may be an incentive not to market. You're in $20 billion in the hook, so in the red, so you may not have the incentive to really expand the coverage and so on. But nevertheless,
we're marketing our hearts
but
out.
now
We
with
can get people to take
with the risk 2.0, that should be the other issue is that question I had for you regarding risk rating 2 and so on. Now that we're moving to the actuarially sound rating, would you be increasing the cap from 250? And yeah, go ahead.
Yeah, so we want to increase the cap. That is set by law. I mentioned the 17 legislative reforms that we've submitted to this Congress. That is one of them, to take the Fannie and Freddie conforming limits, to take out the value of the land. And I'm trying to discern the signal I'm getting from the back of the room here, to try to take out the value of the land, and then to essentially just tag it to that. So when it increases by 2%, the maximum amount that we cover would increase by a comparable percent.
Okay.
Sorry, I just had a quick question for clarity there, which is that aren't there two levels for flood insurance, 60,000 coverage and 200,000?
So there is, you can do 250,000 for your building. You can do 100,000 for your contents. And within the 250,000, there is coverage for something called increased cost of compliance. It's about 33,000, which may be what you're thinking of, which is essentially if you experience a loss and you have to come up to the current building code, we pay 33,000 within the 250,000 can go to getting up to current building codes. That is an amount that is also woefully inadequate. Anybody who's ever elevated a home knows that starts at $100,000, and so that's one of the things that we would also like to see increases and is in our legislative reforms. In terms of the idea that Professor Hamid just alluded to, there is a school of thought in Washington that we should limit exposure as much as we can. And I think it comes up as indifference toward our policy loss. I think it comes up at, maybe we shouldn't be too innovative in designing the product. And at FEMA, that's something that we vehemently disagree with. I would sell a policy to everybody in America if I could. And I'll tell you why. The program is structurally flawed such that it can't collect enough money for our most catastrophic events. So we can be structurally flawed at 4% coverage and not have the resilience in communities that we need, or we can be structurally flawed at 100% coverage and we could have the resilience in the community that we need. Congress would figure it out. If we run out of money, Congress will figure it out. I think the thing with the debt, we have tacitly agreed that we're doing taxpayer financing of the NFIP. We've just chosen the wrong financing mechanism for the public portion, which is debt, rather than, if we want to kick some public money in to help flood insurance be more affordable, then let's do that, but let's do it knowingly and not kind of backdoor it in there through the use of debt, and certainly not at today's interest rates. So sorry to steal your thunder there, but I think
while I'm on NFIP, I have a couple of questions. I've worked with the data, claims data and so on, and exposure data. I got them in 2014. What we found was that 45% to 50% of the policies didn't have any elevation data. And that's, NFIP is the best source of elevation data if you can get it. And there's no ground level data, it's just the first floor. And also, we found that there was no data on construction type, masonry versus frame in those. I mean, it was lacking. You couldn't really do much with that data in terms of validation, calibration, all that stuff. Now that you're moving towards risk rating 2.0, and I hope you're collecting all this data on ground elevation and so on. That's very important for modeling and obviously for pricing and so on. And do you have an index, propensity for rain index and all that also that you have you created that? And do you have, now you're taking into account the type of construction. Are you also collecting data to go along with that?
Yeah, well, I'll say on the data that you mentioned from 2014, and obviously you pulled it in 2014, so the vintage was probably even at least that old or older. Yeah. It always should have been there. There are probably a couple of things going on. One, at that point in time, the ethos was because that didn't matter in how we set the rate. Now, the first floor height mattered, obviously, but some of the other data that you're alluding to didn't matter to set the rate. If the insurance agent didn't put it in there or the company didn't put it in there, it was kind of viewed as a no harm scenario. But now it all has to be in there, and in fact, much of it is drawn from big data sets. So first floor height, you know, as someone who follows the program, you don't have to have an elevation certificate to get a policy anymore, which is an engineer coming out and setting what your first floor height is. And so it's all in there, and it has to be in there because it's embedded within the rate.
Thank you. Okay, I'm going to move on to mitigation. Mitigation, that was another question that Arun had alluded to, is very important. So in our model, the Florida Public Hurricane Loss Model, and funded by OER, which we're very grateful for, basically you can see that mitigation can really have an important impact. So what you have over here is a building, a reference building, frame building, and on top you have an unmitigated house, and then you add in hip roof, you add in shutters, and so on, and you can see that the vulnerability function is going down quite a lot, even at 140 miles per hour and so on, 150 miles per hour. And in the case of manufactured homes, you have a dramatic increase. There was a change in the requirement. Had to be for manufactured home, they had to be tied down and so on. And we've done a lot of analysis, wind tunnel, post-hurricane surveys and so on. And there's a dramatic drop in vulnerability just by having those new mitigation features. So this is our estimate of what the maximum reduction in damage would be due to different features, mitigation features. And you can see something as cheap as AD nails can make substantial difference. We're talking about 38% decline and so on. Of course, that's not going to happen at Category 5. We're talking about more like Category 2 or 3 hurricane. That's where you maximize your benefit, 110 miles, 120 miles an hour. So cumulatively, you could have as much as 40% decline in mitigation, and that's important because this is what insurance companies need to know. The process of calculating discounts that the OER has basically is involved in is, of course, it involves forms and other things, but ultimately it's the scientific data that convinces the insurance industry that they need to, that mitigation is important. And then look at the benefits. So this is 2023, a survey of about, courtesy of OER, 20 different companies in different counties, and with $300,000 coverage, 2% deductible, median premium in Miami-Dade for a 1990 built house, unmitigated, is $21,000. Okay, that's based on the actual. Of course, the range is quite a lot within those companies. You mitigate that house, you go down to $10,000 per year. That's a substantial benefit. And that's, OER has done a very good job in getting that out of the insurance industries. 2000 built house, you got $8,004. Broward, as you go up north where the insurance premiums are lower, obviously the benefits are going to be lower, but still you get substantial decline pretty much everywhere. In other counties, Bay County, substantial. In Bay County, you go from 8,000 to 3,000. So mitigating the house is important.
Could I just comment on that real quick?
Yeah.
I apologize for interrupting, but one thing I just wanted to make everyone aware of related to the mitigation study is that OIR has actually embarked on a brand new mitigation study effort this year that will reevaluate and incorporate any new findings, new technologies, new methodology that's been developed since 2010 was the last time that it's updated its 1802 form. And so one of the things that I asked for when I accepted this delightful job was to be able to go back in and then going forward have the funding available to go back in every 5 years and continue the update. I look forward to working with anyone willing to, but especially FIU and its data as we go through this process, because as you can see there, the difference in mitigated versus unmitigated is absolutely tremendous over the lifetime of a home.
Can I jump in on a small point to drop together?
Yeah.
It may not be actually a great insight, but we are talking about home insurance, not flood insurance.
No, we're talking about home insurance.
This is
Yeah.
when.
Flood insurance will not be the.
Are you going to get to flood insurance?
Well, yeah, I have some information on that. This is for coastal flood. It's a little bit confusing because we're talking about masonry, for example, which is a 1 story, 1 foot above ground. For frame, we have 2 story, 8 foot above ground. And basically, you elevate the building 1 foot, 2 foot, 3 foot. Masonry we haven't really looked at because it's much harder to elevate, but frame, you're getting something like, even when the coastal flood is 10%, 7 foot, which is below the 8 foot, the first floor is 8 foot above ground, still you get 10%, 23%, 43%, because you have wave on top of that, right? And you have the force. So even if the flood level is lower than your house, it still has an impact and mitigation, and it's going to create damage. And so you're going to get a significant reduction in even if you're above the flood level. In fact, if you're looking at inland flood with an inundation due to rainfall and so on, at 9 feet you'd get something like 100%. Okay, elevating 1 foot, 2 foot with this particular reference structure, you can go up to 100%. And now then you have flood proofing, wet roof, that's basically, excuse me, I need to get some water. Can I get the, thank you. So wet proofing is that you allow the water to come in, but you wet proof your floor and your dry walls and so on. You put tiles instead of hardwood. you buy the more expensive waterproof drywalls and so on. And you do that, you still get substantial 1 foot, you wet proof 1 foot, 2 foot, 3 foot, you get significant reduction in damage up to a certain level. I mean, when the flood level is, 4, 5, 6, 7 feet, you really, there's not much benefit you're going to get. But as long as the flood level is not substantially high, you could get significant benefit. Dry foot is where you basically don't allow the water to come in. You seal everything, put foams and so on around, 58% reduction. Okay.
Dr. Hamid,
Yeah.
just quick clarification. So what are these percentages? These are the reduction in...
Reduction in losses.
Reduction in losses.
Okay, another issue, winds at 100 meter are 50% greater than 10 meter. They rise exponentially. If wind at surface is Cat 1, likely to be Cat 3 on the 10th floor. And this, the velocity curve essentially goes up exponentially, but then it kind of peters out around 60 meters and so on. So if you have winds at which are Cat 3 at the surface, it's going to be likely Cat 5 on the 10th floor. So high-rise buildings are obviously more vulnerable. We are building taller and taller structures, especially in Miami. If you look at Miami Beach and so on, downtown Miami, it could be a problem in the future. Lessons of fast hurricane mitigation. The part of the house that's most vulnerable, and that's obvious in modeling and wind tunnel and other experiments, is really the roof-to-wall connection. Even if you put double strap and so on, you got Cat 5, Cat 4, it's not going to matter. Okay? And it's just inexplicable that we have wood roof in hurricane-prone areas. Okay? It just doesn't make sense. I mean, you look at some of the old houses, concrete and so on, in, say, Havana or Puerto Rico, they've gone through 100 years of hurricane, they're still standing. So we need a really dramatic change in the way we construct our houses. Okay? Now, concrete houses don't look beautiful. We like to have these nice, sloping roofs with tiles, colored tiles and so on. Well, at FIU, we have engineered a lightweight, strong concrete roof with waves that can stand up to 200 miles per hour. They can mimic the tiles. We can paint them. Cheap to build and install. The industry has not adopted it. Okay? So here's an example of something that's ready to go that can be useful. Okay, of course, it's not going to look as good as it would in the, but it works. This is an example of that. Now, another issue that let me see, that I'm going to go out on a limb over here. I'm not an atmospheric scientist, but I've worked with them for 20 years. So, excuse me. The impact of future climate change, with apologies to our scientists here. The Atlantic Ocean has been in an active hurricane phase since '95. 5 of the top 10 hurricanes, as well as flood losses, occurred in the past 10 years, after adjusting for inflation. 2 revisions that are given are the AMO, the Atlantic Multi-Decade Oscillation, and then you also have some idea of whether perhaps climate change was involved, but I don't think there are any good studies out there that kind of filter out the climate change, from what I understand. So we don't know how much of this is, by far it's the AMO. Increased dust storms from the Sahara has killed some of the storms. Now, climate change is expected to increase temperatures. Increasing temperatures, ocean temperatures in the Atlantic should lead to more frequent, more intense hurricanes. But increased, at the same time, it's going to increase temperature in the Pacific Ocean. And my understanding is, and this is something that you can correct me, is that actually will increase wind shear in the Atlantic and may even reduce the frequency in the Atlantic. Okay, so the climate change, so you got 2 things going on. Rising ocean temperature in the Atlantic, which increases intensity frequency, but then you have a big tub out there in the Pacific, which is warming up, and that actually reduces, increases wind shear and reduces hurricane frequency here. So it becomes an empirical question. Obviously, more likely the intense hurricanes and so on are going to dominate, but it's an interesting empirical question. as to what will happen to the loss cost with these offsetting effects. Okay, or how much of that would be mitigated by the wind shear, but that's an open question. Some other points. Legal issues we cannot model. Law and ordinance is one. Flood versus wind loss, that is something that, once we have the flood model and the wind model, we'll try to tackle, perhaps. Insurance crisis. And I just want to mention what Florida has done to help out. It's created the Florida Cat Fund. It's critical to the stability of the market. It's a reinsurance, and it's got a trigger of $7 billion over a loss, and there's a cap on top. So it's you still need to go to the reinsurance industry, but it has about $12 billion, or last year it had funds, plus another $3.5 billion in prevent bonding authority. So it's got a capacity of about $15.8 billion. And it's tax exempt, so it can build up reserves faster than reinsurance companies. So that's actually a big asset for us. We also have the Citizens Insurance Company with a lot of backstops. I mean, they have the ability to basically impose charges across different lines of business, insurance lines, and as well as other companies, et cetera, et cetera. And they, last year, they had a $13 billion capacity. After, I guess, Ian, I'm not sure much. And then you have the Florida Insurance Guarantee Association, and you have the state-supported reinsurance fund, which was created last year to the tune of $2 billion. So, and then, of course, there is this possibility of transferring of cat risk to capital market. The total worldwide capitalization of stocks is over 100 trillion, and bonds 120 trillion. Stocks routinely go up by $1 trillion a day. Okay, it's not unusual. The capital market can easily absorb huge cat losses if you can construct securities to capture that risk with adequate compensation. So there is a large unused capacity to transfer cat risk to the capital market through cat bonds and insurance-linked securities. So 2021, there was 20.3 billion property-related ILS. About 113 billion cat funds have been issued since 1997, and FIP has about 1.2 billion cat bonds outstanding. And so this is, I think, one way we can go if we are able to create securities that would be attractive to investors. The problem was the stock market was doing so well, since 2008. It has done very well, and even before that, in the 90s, it did very well. That these cat bonds were, even though they paid higher interest rate, were not that attractive. But we have to, finance experts are working on how to create these instruments that can transfer the risk, because there's a lot of unused capacity over there. That's the future. Of course, the insurance industries may push back, but I think that it's important to go that way. Thank you.
Thank you, Dr. Hamid. So great discussion. Lots of points were raised here by the presenters. In the interest of time, I would like to invite some questions from the audience.
Should we give Mr. Jackson a chance to respond to anything?
So if you want to say a few things about the questions that were raised by Dr. Hamid, or
nothing really off the top, and I do want to get some audience questions, so I'll defer. That'd be great to get one of those.
I'd like to ask you, I'm going to be talking this evening, Saturday and First of all, I have to thank each and every one of you, including the audience, but particularly you all. I waited to the very end for this, absolutely, and I enjoyed it because I'm going home. I'm going home as a senior, elder, living in an HOA, surrounded by lakes and buildings that have received tons of public monies, and they are garbage. The walls sweat, the animals in the lake are leaving, if not floating dead, and they're connected to public canals that lead into, et cetera, et cetera. You've heard this over and over again. I'm going to carry back the same disease to the elders. Also, we're surrounded by major corridors. I've got my own mapping, actually. I'm doing my own GIS tracking. And so I'm going home to report that I came here, and I'm going to make copies of each one of these agendas, and I'm going to give it to them. And in the workshop, when it's good, but the only one they're probably going to wake up from nodding from, and don't get, I'm not saying seniors only one that age, but when you feed us well, we nod. And pay attention to is this one. Because the average tenant, my average neighbor and I, pay about $4,000 a month just for the HOAs to fix what they can't fix, and probably wouldn't do them any good because they're not even mitigating, they're just patching. What would be the message that you would give me in a short synopsis about the hope that they're having? Because half of my neighbors are already gone because they can't pay the fees. And one of the biggest expenses of being a senior and elder in the HOA in Miami-Dade County, particularly Miami Gardens and South Dade, is the insurance. So here's your chance to say something to my senior self, not interested, not professional, not certified, and without any youth in here that can bring me back home, any intelligence on reducing the flooding and perhaps not being homeless anymore.
I would say from a flood perspective, at FEMA, we passionately believe in a means-tested affordability program for those that are having trouble affording the insurance piece of things. That's our piece of things. And it's something we promoted the last number of years and, would really encourage Congress to act upon. We want to have the authority to make, to give help on flood insurance for the people who need it the most, but by law right now we can't. So I think, a lot of the issues you raised are local issues, so I can't comment on those as a Fed, but from the affordability of flood insurance, we certainly agree that some help is needed.
Unfortunately, I visit Tallahassee 4 times a year, and it's just to pick up some things, or I go with a bus of people. And so it's not so local for me as you think it is. The state legislators and the representatives, the senators, and even the executives give me no data like this, nor do they offer, nor do they attend meetings. So it's not so local. And as inland persons directly affected, and culture is most at risk, and homeowners most at risk, it's not local, and as you all say, it's international. So I don't even want to hear local anymore, and I think that's great if I hear about coastal. No disrespect. But this part right here, making sure that the government and that industry hears us, because it's literally leaving us homeless, sick, dead, and without our property. So I hope that it doesn't come that general, doesn't come that insensitive, that people think just because we're local, we're not drastically affected by climate, in so many ways. But what most of all is that people don't speak to the terms, the data that's most relevant to us. I want to thank you all on this task force for really hitting that one, and thank you, Mario, for making sure they did. Anybody else got anything to take home to the seniors?
That sounds like your cue, Commissioner Jaworski.
I think the challenge is one of the things that I keep in mind almost every single day, and when someone calls my office and gets my number, every chance I get, I talk to them directly. About a month ago, I was on the phone. I called a woman back who had left me a message on my line. I called a woman back all the way from Tallahassee, and I spoke to her all the way from Tallahassee to Gainesville about the problems she was having with her insurance bill and her experience. And we just had a conversation about it and how difficult it's been on her family. The unprecedented increase in the cost of insurance in Florida caused by a number of factors. We can't point to one. If there was one button that could be pushed, I can assure you I would have pushed it by now.
We'll be calling you a lot.
You can have my number. We take it very seriously. It's not lost on anybody at the office that this has been a pain point for Floridians everywhere. I think it's increasingly becoming obvious that it's going to be a pain point for much of the rest of the country. But the bottom line is that the worst part of any day is when you actually have to approve a rate increase. And the data can be there, the data can establish it, it's supportable. There's a real need, because ultimately you need to, a company needs to be able to pay claims. But this has been a very difficult market, and the human element of it all is certainly not lost on me.
My question is actually a bit related to that. So we heard from you, Mr. Jackson, very reassuringly, at least to me, that the new what's it called, rate 2, is much more, has premiums that much more reflect the risk. And my question is actually to the others on the panel. With the Citizens Plan and now with this Florida cat thing, this may be difficult for you to answer for political reasons, but I think it's really important, is how much do insurance rates outside the federal program actually reflect the risk? You fly over in an airplane, as we all do, there's very, very strong concentration of wealth right in the coast. So why are people paying, 20 miles inland paying so much insurance? Is it my imagination, or do we still live in an environment where poor people living inland are subsidizing wealthy people on the coast?
And can we actually jump to Phil Stoddard and get this question as well? Rep.
I think we got part of that answer with that nice picture of the gray lag geese called Glide Path. I mean, for 10 years, the folks on the inland are going to be subsidizing people on the coast until those rates equilibrate with the risk. But my question was a little different. I mean, I read the papers, and I see sort of the menu of problems we have in Florida with insurance. And they are, of course, the reassignment of benefits, which has been a big problem. Easy one for the legislature to fix, I should think. There's been insurance frauds, got a lot of press, but the other one that's gotten a lot of press, and I see the legislature doing nothing about it, and that is the insurance companies that hire an adjuster, get the cost of fixing a damaged property, and then short the homeowner. And I hear about this in every single article I read in every newspaper in Florida, and I want to know why. I keep hearing this story over and over again. That the insurance company's adjuster comes up with a cost of fixing the house, and the insurance company then doesn't pay. And how come this isn't getting the same attention from the legislature, and I would guess your office as well, so given that this seems to be like the biggest consumer problem, other than having your policy canceled altogether?
Thank you. And if we could just answer in a couple of minutes, because we have to.
Seems like both these questions were targeted to Commissioner Yaworsky.
It seems that way. To go at the first question on which is one that we get pretty commonly about the idea of more inland areas subsidizing the risk of more coastal areas. It's far more complicated than flying over the state of Florida and trying to make that evaluation. The fact of the matter is that there is not a point in Florida that is more than 70 miles away from a coastline. It is, when we consider coastal versus inland, you'd have to define what those terms initially mean. Does coastal mean 500 feet from the water? Does it mean 5 miles from the water? Does it mean 10 miles from the water? In a 1 in 1,000 year hurricane event, the degree to which it matters decreases steadily, very quickly. And you can see that most recently with Hurricane Ian and the impacts that had well inland of a coastal area. And so it is, from an insurance perspective right here and now, it is extraordinarily expensive to insure in the state of Florida. There are some of the reasons that I think this panel has done a great job of discussing, everything from insurance fraud to the litigation crisis. To give you an example, so OAR developed the data around the 9%, 79% data around the propensity for litigation in the state of Florida. More recent state of Florida versus the rest of the country. And that was developed with MCAT, what we call MCAS data, which is a market conduct survey that is done nationwide. To give you an idea of just the difference in Florida around the challenges with litigation, I know this is not your direct question, but it is related to the overall cost of insurance in Florida. What we developed a new data called the PCLR, which is the most sophisticated one in the country, directly targeted towards claims handling. And one of the questions related in that PCLR collects the life cycle of the entire claim so that we can evaluate an insurer's performance. Its first year of deployment was last year, 2022, for the 22-year calendar year. As part of that data, we ask about litigation trends. The statewide average for a litigated claim in 64 counties is 5.5%. So 5.5% of claims were litigated on average in the state of Florida. If you take the tri-county area of Miami-Dade, Broward, and West Palm Beach counties, it was 27% of claims in these counties were litigated that have not been impacted by a major catastrophe in over a decade. If you take just Dade County, that number increases to over 33%, or 1 in 3 claims made on a property were litigated. We had, with no rationale or information available to indicate a legitimate reason for that other than an abusive tort environment. The cost on the system has been tremendous. The time to restore that will take time, but when we talk about costs, one of the things that we're trying to educate, and I really appreciate the discussion about messaging, because I think that's so crucial in a lot of this, but and I'm simplifying it by saying messaging, and I recognize that, but the overall impact of this is we don't have a market where we can afford expensive third-party inefficiencies in the system, and I think there has to be a realization of that over time. Maybe it's beginning to develop in Tallahassee, maybe it isn't, but we can't have third parties, whether that be public adjusters, litigators, anyone in the system that is adding a lot of costs onto it because consumers are paying for that. To your point about the biggest problem around around adjusting and the way companies behave, let's start with the basics of what's happened in Florida's market over the past course of 30 years since Andrew. Hurricane Andrew came along and it pretty much upended certainly Florida's property market in 1993, but in a lot of ways the United States' property market. We've had to rebuild our market about 3 times now because we don't have the degree of participation in our market that other states do. Most states, when you look at what you'll see in a admitted market type scenario or a market type scenario, you'll see about 50 to 60% of the market is taken up by the Super Bowl companies, what I call the Super Bowl companies. So there's ants or bats, whatever you want to call them, but they are the ones, that's your Allstates, your State Farms, Nationwides, et cetera. About 50 to 60% of the market is made up of that. Then there's some regional carriers and maybe a few state domestics that are filling in pieces here and there. And then you may have surplus or residual depending on where you are. In Florida, at this point in time, we're down to we're up to about a 60% market share of what we call single state domestic insurers. In some cases, they are literally mom and pop operations that are small companies that are heavily reliant on reinsurance. If you look at your premium dollars right now, if you took your whole premium and averaged out across all consumers, about 45 to 50% of what they're paying in their premium right now is going to be directly from the insurer to a reinsurer. And that got extraordinarily expensive in 21 and 22. I'm kind of meddling the overall messages in this at this point, but we haven't really had the ability to afford top service from insurers because the answer to that will be that they will just leave. One of the goals with the legislature in the 2022-2023 legislative session was to find a balance where we can have a rational litigation environment where we can reduce the cost of litigation, the pressure on litigation, and also come in with Senate Bill 7052, which gave tremendous new authority to the Office of Insurance Regulation to monitor the behavior of insurers. It added 29 new positions to what we call market conduct, which is directly involved in examining the behavior of insurers. And so I think that it also, in a key area for the first time, it required insurers when they all have what is called a claims handling manual or a disaster response plan of some kind. And it required insurers, their CEOs, to attest that this plan that they have that had been filed with the office, that it's one that they can actually have the resources to effectuate and make happen following a disaster or catastrophe. And the reason for that is because just like what we see in the news articles and other things about these horrific experiences, the last thing it did with adjusters is it also ended a practice, which is probably, if not the top, one of the top 2 complaints that I hear about is, especially after a catastrophe where a consumer has called their insurer 15 times and they've talked to 15 different adjusters and they've had to submit paperwork a dozen times and it seems like nothing's going on. I think I'm being cut off, but I hear you on that. We are working that issue. Please reach out to us. We recognize the challenges with claims handling. We recognize that companies in Florida don't always behave as well as they should, and we're working on improving it.
Here's presentation. Last final word from Deputy Administrator Jackson.
Just 30 seconds.
Yeah.
The question of this, a lot of unpaid paid claims. Again, in the case of Ian on the West Coast, when you have a house that is damaged so extensively, there's no watermark. So you can't figure out whether it's literally flooding or it's rain or whatever that's caused damage. It works both ways. The insurance companies use that as an excuse to say, go to the, the flood insurance should pay for it. Or if you don't have it, tough luck. Even though it could have been really due to wind and so on. And on the other side, you have homeowners who are basically litigating. So it's both ways. Until we have a clear way of differentiating between the two, by and large, the insurance companies are going to say, it should be the flood that should be paying, regardless.
And in fact, one of the reasons, one of the things that escapes the data around that is that, and I don't want to put you on the spot, but one of the things that is required by, if you have an NFIP policy or if you're looking for FEMA assistance, is that you exhaust all remedies through other coverages you may have. So generally speaking, you initially, regardless of whether or not it's wind or water, or obvious it's wind or water, you have to go through a claims process with your wind insurer or your other perils insurer.
Yeah, and I would just say that extends to disaster assistance, and we have some new disaster assistance rules coming out that are going to make it easier, cut down on the red tape to get disaster assistance, and also make it available to people who are underinsured. And it really has been incentivized against, if you have insurance, you're viewed in the insurance bucket, and the presumption from a disaster assistance perspective is you're all good. We don't need to worry about you, and that's not always the case. So we don't want to encourage active underinsurance, but we also don't want to treat those folks differently than others, particularly when you look at a market like Florida that has pricing challenges where the cost is so great. Many times people being underinsured is a sort of back-end affordability measure.
Thank you, everyone. Great panels, lots of points, great discussions. Thank you for all these points. And now, with that, we end this panel, this session.
Thank you very much. Thank you.